Well, joining me now in studio with more is Greg Farinello, head of U.S. rates at Amerivet Securities. Greg, great to have you on the show this morning.
Kristen, thanks for having me. Good to see you.
Good to see you, too. A lot to talk about, and still a government shutdown that has persisted. What does that mean for markets?
So for markets in general, I think if you look at overall performance, I think the markets in general have discounted the shutdown overall. We've seen this before in the past. Typically around 8 days, I think, is the average for shutdowns. So we're past that. It does strike me that both sides are a little dug in here, so we'll see what the weekend brings into next week. But from an economic perspective, we're not getting the data that we need. So we missed the employment report. This upcoming week, this Thursday, we're due to get the CPI report. Now, if we were to get some resolution before Thursday, we'd not only get the CPI report, but that employment data is in-house. It's just a matter of being released. But we'll have to see. Timing is everything here. But I think what the market is missing more than anything is the economic data.
Okay, so economic data, we know we'll get some data points as you referenced, but that next Fed decision obviously at the end of October. What position does that put the Fed in?
So I think if you look at the FOMC minutes that we got this week, the Fed seems inclined to continue to still go here. What we did get is the ADP report, which is private payroll numbers. And there is a transition between public sector job growth over the last couple of years to the private sector. That transition is taking time. We're seeing that in the data. So I think they'll lean on that. They'll lean on some other things. But if you look at pricing, we're priced for 25 in October. We're close to being priced for another 25 in December. And if you listen to the FOMC minutes, the majority of the committee is saying we're inclined to continue easing for the remainder of 2025. So I don't think it's going to impact the Fed decision all that much.
Yeah, seasonality can be at play right here. We've seen stocks set 33 record closes this year. It's been pretty impressive, Greg. But the path forward, what does that tell you about what could be ahead?
So earnings clearly important. Forward guidance. Delta reported good earnings, good forward guidance. We get the banks next week. I would say, like earnings season is always important, but the fact that the government is shut down, we're not getting the economic data. The earnings season, I think, and forward guidance will carry more weight. In terms of equity indices, if you go back, you look at that period in April, a clear inflection point. Even if you go back 25 years, that drawdown. Typically, when you see that type of drawdown that we saw in April, we go on to make new highs. Now we're going on to make even more new highs. So we've been, in general, constructive on markets, credit, rates, equities. Having said that, we can't rule out some consolidation here along the way. But I think the backdrop in general for markets is still very constructive.
I do want to talk about what we know about the economy, right? Certainly the jobs data has been worsening, tens of thousands of jobs on a good month, but also losses too, at a time where inflation does remain sticky. What is the lens that you see that through?
So there's tension there, and that's what the Fed is saying. So if you look at inflation, we're running 2.5% to 3%. If you look at core inflation, both CPI and PCE, the PCE is what the Fed watches more, we're running closer to 3%. At the same time, if you look at the break-even job numbers given population growth, we're falling well short to keep that unemployment rate low. And I think that's where the Fed's concern is. Atlanta Fed President Bostic, who's been a little bit more on the hawkish side, came out yesterday. The regional Fed presidents talked to their district. They talked to small, medium-sized businesses. And he sounded a bit of an alarm that he's becoming a little bit more concerned that things may be weakening a little quicker than expected. So short term, my lens, the Fed is going to lean more toward employment than inflation. I think as long as inflation is between 2% and 3% and the employment market remains weak, the Fed is going to continue to ease and have that bias to come down even more.
What do we know about seasonality in the fourth quarter and what we could expect these next few months?
Well, that's interesting. I mean, seasonality-wise, right now, not the best time. Certainly, as we head into year-end, you could see some profit taking. But I think as we move into 2026, the backdrop, I think, for the economy is good. I do think the job market over time will even itself out. It may take a little bit more time on the private sector as the administration tries to reprivatize the economy. But the backdrop in general for markets, I think, as we head into 2026, I think still looks good.
Yeah, and 2026 will be a key year indeed. speed. So in terms of rate cuts beyond this year, do you think that those could be in the cards?
Sure. So if you move past the pricing for 2025, if you look at what they call the terminal rate, where is the Fed ultimately going to rest and get to? If you look at the end of 2026, if you look at that pricing, we land right around 3%. 3%, if you look at the summary of economic projections, that is the Fed's estimate of the long-term neutral rate. And that's ultimately, I think, where they want to go. They want to get down to more neutral levels. I think the question is the speed in which they do that. Fed Governor Myron coming out recently saying he wants to get there really, really quick. I think the General Committee, including Chair Powell, is saying we want to get there too. We want to get there a little bit more slowly.
Yeah.
So we do expect rate cuts into 2026, but we also see the Fed taking a more gradual approach here as the inflation rate remains above their 2% target.
Do you anticipate the government will reopen soon?
I hope so.
Yes, we're waiting on that, indeed, and any developments on that case. But if rate cuts do extend into 2026, as you just outlined there, Greg, do you think that the momentum in equities can continue?
I do. If you look at historically, I mean, we've gone through these periods of zero interest rate policy, quantitative easing, all of these things that have juiced markets over time. If you look at the long-term average of the Fed funds rate, it comes in right around 3%. So the question is, can the economy handle a 3% funds rate? Can the economy handle the rate structure that we have right now? Can markets handle the rate structure that we have right now? My answer is yes. And if it's combined with, if rates come down gradually, even gradually toward 3%, and it's combined with good policy coming out of Washington, there's no reason that markets can't continue to perform very well.
Greg Farinello, head of U.S. rates at Amerivet Securities. Greg, always a pleasure, and thanks for joining me in studio.
Thank you, Kristen.
It's good to see you.